I'll try and keep an order on you, and do identify yourself and try and make it a short and sweet question.
Alan Aaron's my name. I like your 5 opportunities. I tend to question your 4th one, which is paying, particularly well-depreciated asset owners to shut down. Why would you take that politically unpopular step of subsidising or nationalising the cost of these guys, rather than regulating their output and forcing the equity owners to take a haircut, notwithstanding the concerns about sovereign risk, which really isn't true, because these assets are way depreciated anyway?
Well, I agree with you. If you thought it was politically possible, right, to place a sufficiently robust carbon price to accelerate and depreciate these assets so these guys would walk away from them anyway, more power to you. But we've been trying that for at least 25 years.
Carbon price. Why not just regulate emissions?
Well, this is what...
For certain groups of emitters.
This is what Obama's trying to do, right? And he's going to find himself, he's got the Koch brothers, the billionaire Koch brothers, right, pouring hundreds of millions of dollars into every political race in the midterm elections this year, right? And this is exactly what he's trying to do. He's outrunning, so he doesn't need Congress because he has authority under the Clean Air Act to do that, right? But as soon as they issue those regulations, they're going to be sued. They're going to be in federal court. I mean, I agree with you. It's much more efficient to either adopt regulations, right, that depreciate these assets than my option. But I haven't seen anything in my entire time that suggests that politicians have any appetite for that. Right? Quite the opposite, right? That's why I'm left with, and while we're waiting for that to happen, and I think that will eventually happen, but will it happen on a timescale meaningful to improving efficiency and reducing those emissions? That's the ultimate question. I don't think we can wait for these guys to figure this out, right? I would rather just step in there, right? Find a way to create a sufficiently robust value proposition and pay these guys to walk away. Right? I mean, it might very well be that the market, in the absence of regulation, prices this risk, right? Which would be fantastic. Because this is what the market does all the time. Identifies risks, price that market does all the time. Identifies risks, price that risk, right? And allocates resources on a risk-adjusted basis.
Hi, I'm Veronica Menendez. I used to do climate policy for the New South Wales government. I'm just interested in what you're saying about the pension funds and superannuation. Australia has this massive pool of pension funds for our size because of compulsory super. How much do you think that could be a driver for the kind of green bonds and that sort of green investment that you're talking about? Like, could it be that Australia is perhaps going to be a leader in that field because of compulsory super?
Yeah, absolutely. So did everybody hear the question about Australian super? So our super is about, correct me if I'm wrong, about 1.6 trillion for a country with 23 million people. So I think we're the 4th largest pension market in the world as a result of compulsory super, right? Which is a fantastic thing. I know that Vic Super, Uni Super, Catholic Super, these are very, very progressive supers that have figured a lot of this out. They have made announcements about increasing their exposure to infrastructure, right, and green infrastructure. And they're looking at, I mean, the most progressive pension funds in terms of getting this are Pensions Denmark, Storebrand in Norway. Storebrand in Norway came out and said, we're going to have 20% of our portfolio in green infrastructure. Right? So yes, you're absolutely right. This is an area where we could absolutely dominate, And we have good forward-thinking supers. The question is, could we get some regulatory help, right? Some market help? I mean, how do we take our comparative advantage in superannuation, right, and leverage that to accelerate this and put us? I mean, it gets back to my questions about when do we invest in the future? How do we invest, right? My argument to super funds, to pension funds, is, look, your liabilities are rising so quickly that before you never try to hit a 6, right? Pardon my cricket, right? Just get out there and knock out a couple 1s and 2s, you were fine. But now your liabilities are so high, every once in a while you got to step up there and try to hit a 6, right? This is your hit a 6 space, right? Especially in the game-changing space. And so Warburg Pincus and others are now moving, there are several funds now that are investing exclusively in that game changer space. Yes, absolutely, we should be doing that here, right? And I put sovereign wealth fund as the last thing on the list, right? We ought to be moving and doing what the Norwegians did, right? with their, now the world's largest sovereign wealth fund.
Down here? Here.
Hi, Sian Green. I just wonder, with the bonds, like all that bond issuing, the World Bank issuing bonds, how do they pay them back? The people who invest, how do they pay back?
Yeah, well, they create an asset, right? So it's an asset that generates revenue, and that revenue is what's used to pay back the bond.
Yeah, obviously, but
Yeah.
how does the revenue? So I imagine there's lots of little people in India or somewhere offsetting, they're investing in efficient stuff. How does that pay? I guess that's what I'm...
Oh, so are you concerned about the fact that, about commercial conditions, about whether or not you can make money because people can't afford to pay?
Or sort of. I'm sort of saying the World Bank, they're a AAA,
Yeah.
they've got a AAA rating. They go,
Yeah.
we're going to, borrow some money from you guys. We're going to put it in energy efficiency or whatever. I'm just sort of...
Okay, so I'll answer that question this way. I'll answer the question this way. There was a Chinese delegation that came to the IEA, the International Energy Agency in Paris, about 2 months ago, and I was fortunate to get a chance to meet with them. And they're the team that's working on the energy part of the next 5-year plan. And they said something quite startling. They said, look, we made a mistake. When we started our development, we took the Western model, super capital intensive, energy inefficient, right? And it led us to think that things like coal were the cheapest, right? But if you factor in all of the costs of coal, right, including their, especially in China, the healthcare costs, right, coal becomes the world's most expensive. Right? So if you start to change that mindset, right, then in fact those cleaner, those cleaner assets are in fact cheaper. Right? It's like people who buy, I remember I had Good Guys, working for Good Guys as a client, and they have all these washing machines. You can spend $200 on a washing machine, or you can spend $8,000 on a washing machine, right? The cheapest one's not the $200 one, right? So that would be part of my explanation in terms of the fact that in many of these places, they recognize that using GDP and using poor metrics to value these things is incorrect. And it's the more expensive options that are actually cheaper, if you will.
But you still got to get real money somewhere back to the person.
Yeah, but remember, but the World Bank's AAA rated, right? And the reason they're AAA rated is that they pay back, right? So if you're the investor, you don't need to do a whole lot of due diligence. You're backstopped.
The GFC came around, sort of, but...
Sorry, unless another GFC comes around.
No, that's how the GFC came around, kind of. Like, people had lots of AAA rated stuff that, they put out and they were really checked and la 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 and whatever. It's just, it's interesting because we know that it's a lower, of course it's cheaper on the long term to buy $800, but if I buy my $800 washing machine, somehow I've still got to give some real money back to you somehow.
Yeah, but if you're Malaysia or Indonesia or Cambodia and you can't afford any more consumption subsidies for petrol, right? Then in fact the investing in building or buying fuel efficient vehicles or battery electric vehicles is much more attractive. But you're right, you need to aggregate in many of these places where you're investing, right? Yeah, you need to have that cash flow, right? You need to have those customers, they need to pay back. World Bank's obviously very good at finding projects that have stable long-term cash flows. That's why they can keep their AAA rating.
Michael, Freddie Sharp, thanks for another great presentation. Can I explore what might be an inherent paradox in the analysis? Because it's predicated upon the fact that GDP needs to grow fivefold by 2050, but GDP is an inherently flawed measure of economic activity. And your premise is that the existing economic model can't possibly grow fivefold by 2050, so we need to have a different model. If you applied GPI, another measure, to ascertain how much economic growth we really need to achieve, is it really fivefold? It may be a simple doubling or a 10% growth. Are your conclusions the same if you measure economic activity in a sensible way, not a sort of stupid way as GDP requires you to do? And would your conclusions be the same, and would the results be the same?
Yeah, I mean, Freddie, great question. Look, no, I mean, I think GPI, if you use real metrics, right, and judge things that matter, then in fact you don't need fivefold. Plus, let's be honest, I'm going to go off the record and say I don't think there's any chance we're ever going to get the 305, regardless of what we do, right? There are certain constraints that are going to keep us from that. But I'm trying to play in this part of this crazy world game in terms of the wrong metrics, right, is if the reason we're not taking action on climate change is because it runs orthogonal to our growth, right, then if you're going to win on that argument, again, on a timescale meaningful to solving this thing, you have to leverage part of that crazy, stupid argument, right, and you have to show them, right, you have to show those men and women that sit around the prime ministers and presidents, right, that this is their pathway to growth, for France, for example, right. So you can't simply say, well, it's not the OECD 305, it's GPI, and it's, it's 140, right, or a lower number. So part of what I'm doing is, yes, I'm undermining part of my own argument, but part of what I'm doing is, because we have such a short period of time, as you know very well, the steepness of that decarbonization curve is now so sharp. We have a short period of time. We need to get action. So appeal to the greatest force on the planet, right, and get them and get the people with the most amount of money moving in this direction. And unfortunately, to do that, you've got to play. This is part of the playing the game, and that is you've got to play this growth. Personally, if you ask me off the record, I think 305 is a crazy number.
I should say you are being recorded here, Mark. Other questions? In front of you.
Michael, just to follow on to Freddie's comment. I mean, I know you kept away from climate as much as you could and stuck to the economic argument. But you still hinge around the 2 degrees C objective and so on. I mean, if you actually look at the carbon tracker work, everybody says we can only burn 20% of global fossil fuel reserves, proven reserves, to stay below that 2 degrees C. That's assuming something like a 50 to 60% chance of actually achieving it. Now, if you actually look at the latest science, you actually have no carbon budget left if you take a reasonable chance of, say, something like 10%. I suspect that that's actually going to kick in a physical sense over the next decade or so. So the context in which you're doing this is actually going to change too. And I just wonder, I mean, once you get to that point, I know all the problems of getting everybody to change anything and the points about, the most efficient ways of doing it. But how does this scale up, do you think? If you actually got to the point of accepting you didn't actually have a carbon budget any longer, and you really were going to have to move into sort of emergency response.
Yeah. Did everyone get that? The question? It's the targets and the carbon budget that we're talking about is expressed in terms of relative probability, right? So the 1,000 gigaton number that the IPCC and Meinhausen, this sort of key paper talk about, if you keep under a certain number, it only gives you a 50% probability or a between 20 and 50% probability of achieving the target. So Ian's point is that if you want to increase those odds, right, of not going beyond 2C, then in fact the carbon budget that you have is significantly smaller, almost zero, right? So the question is how fast, right? If that's true, and we only have virtually no carbon budget, then how fast can you scale this? Well, one of the other reasons I didn't mention about buying out those assets is that one of the things that keeps you from scaling renewables apart from, let's say, some energy storage issues, which are not insignificant, is the fact that there isn't enough additional capacity online to allow them to scale liquidity. So the other advantage that you get from shutting down those coal-fired assets, for example, is you leave additional, much more room, right, for those things to scale. Now, Stephen Chu, Nobel laureate and outgoing U.S. energy secretary, said normally these major energy transitions take 50 years, right? So we certainly don't have 50 years based on if we have some carbon budget or no carbon budget, right? But that 50 years is because we hang on to the incumbents as long as we possibly can, right? And the transition takes longer, right? So, I mean, if your model of the world predicted the last financial crisis or the devaluation of the Mexican peso or any of the other major events, then I'm more than happy to talk to you. But about predicting what might happen in the future. But Ian's right. I mean, let's be honest. Those 5 things I mentioned. Not only do we need to be successful in them, we need to be unbelievably successful. In fact, more successful than we've ever been in investing in anything else, right? That's with a carbon budget, right? That's with a little bit of a carbon budget. Without the carbon budget, things become even more problematic. So, and then of course, Jim Hansen is saying 350 and climate sensitivity 350, 1 degree, then you're not talking about additional emissions, you're talking about going backwards. So, yeah, I mean, let's be honest, people. This is the only way we're going to do it, right? But Ian has a very valid point. The steepness of the challenge is very, very great, and we would need an absolutely unprecedented response right here, from both on the policy side, on the market side. I shouldn't overstate that or understate that.
Do you have any more questions? Okay, we might have to make this the last one, so I hope it's a good one.
Harley Wright, I'm a climate tragic like Ian. You mentioned the Mainshausen carbon budget, 1,000 gigatons of CO2 that we can emit. And I'm a great fan of contraction and convergence. Would you care to comment on that and how maybe at the Paris COP in next year that we could get a global agreement to share the carbon budget of 1,000 gigatons fairly between all countries, and what that might mean in terms of trading, especially under contraction and convergence, where the poor countries, low carbon countries, have relatively low emissions and can sell all their excess permits to the gluttonous carbon emitters like Australia.
Yeah, so I don't know how many of you heard the question. Very interesting question. So there's this idea that's been around for a while that ultimately what we need is contraction and convergence. That is that that we need to, per capita emissions are very high in industrialized countries, they're very low in developing countries, and so we need contraction, we need to bring those so that they converge, right, contract and converge, right? So we need India's per capita emissions to increase, right, while Australia's and Bahrain and the US and Canada decrease. And so if you take this idea that it's no longer annual emissions that are important, so it's not the shape of the curve that matters as much as the total area under the curve, right? So that there's a total amount of allowable carbon that we can emit to protect ourselves from dangerous anthropogenic interference with the climate system, to use the UNFCCC's. So this gentleman's interesting question is, what if we shifted the negotiations towards contraction and convergence, right? We picked a number in terms of the total amount of emissions, right? And we allocated those to countries. And so poor countries could either use them, right, on a high carbon pathway and use their allowance to emit more, or they could take a low carbon pathway and sell their allowances to countries, right, that want an increase. Right? I mean, fantastic idea, right? Politically, unfortunately, near zero. I mean, the French government team organizing COP21, they are horrified at the prospect that if we do not see enough progress in Lima this year, that the parties may agree to shift the key conference from 2015 to 2016 to COP22. That makes Paris a lame duck conference and makes Francois Hollande's re-election chances probably go to zero. So the opportunity to introduce a new idea, even a great idea like this, at this stage of the game, my personal view, politically very, 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 very difficult. I mean, there are other interesting examples, other ways to do this, but numerous governments have already said we have zero interest in moving the discussions towards an allocation of the remaining budget. Again, if you think this is going to be expensive, not hard to imagine that you would refuse to get into a negotiation to allocate some remaining budget.
Closing remarks? Yep. No worries. Okay, please join me again and thank you, Michael.
Thank you.
Okay, I'm not even going to try and summarise that. There's a lot of ideas. We can make the presentation available up on the CCRC website and others, no doubt. There's also a background paper, which is that also something we can distribute?
Yes.
So that's an opportunity to explore these ideas in more detail. I'll make just perhaps a few sort of closing thoughts on this, and you know that Michael started with the challenge to conventional wisdom, and I think that is very important right now. Conventional wisdom is not serving us well in this space. The challenge of climate change, and if you just want to put it in an economics framework, I should note the latest IPCC report has a chapter now on ethics and economics of climate change. About time that got more attention. But I'd certainly urge caution for some of the IPCC's work led by Professor Richard Cole on the damage costs of unchecked climate change. We are facing, as Ian and others have raised, the potential for catastrophic damage to the economy, but far more than that. On the opportunity side, and I think the point was made over here, yes, market opportunities, but governments still frame those. Governments can still shut down Uber and Airbnb, and the incumbents are trying to get them to do it. And to the extent you've still got to implement projects that make money, the government's role in creating a favourable environment cannot be underestimated. And then for capital markets, you made the point, you tell your students, the challenge is one of capital market motivation. It's important to realise a lot of public around the world aren't particularly pleased with capital markets right now. They disgrace themselves in the global financial crisis, greedy and incompetent. But there is an opportunity for them to do some good. And the Clean Energy Finance Corporation here in Australia, I think, is a great example of what can be done. It's certainly worth looking at what they've been up to. Please join me again in thanking Michael and also Ian Dunlop.